I'm back with another video. In this video, we are going to talk about what the main topic of this video. In this video, we are going to talk about what we are going to talk about. Does it seem? Every day do I don't know if they are doing or I'm little bit today. Just because I don't want to do this due to the stream. A variety of measures of national income and outcome use economics to eliminate total economic activities in country or region, including gross domestic product, gross domestic national income and adjusted national income, adjusted for natural resource depletion, also called NNI in factor cost. All are specifically concerned with counting the total amount of goods and services produced within the economy and various sectors. Usually defined by the geography and citizenship. It is defined in the rural income of nation, also restrict the goods and the service. That for instance, a measure count only goods and services that are exchanged for money, including water goods, and which while other measure may attempt to include water goods or implementing monetary values to the national count, arriving at a figure of the total production of goods and services in a large region of a country and a large amount of data collection and calculation. Although some attempt for made to estimate national income as long as the 17th century was systematic keeping national account of the which these figures are part. 30 the United States and European countries that impetus the major statistical effort was the Great Depression and rise of Keynesian economics, which predicted prescribed greater role of government in national income. Necessary of government to obtain accurate information so that the intervention into the economic could proceed disposable market value in order to account how good and service it necessary to assign a value to the value that measures the national income and output sign. The price of which is when bought or sold the actual usefulness of a product its value is measured assuming the use value of different three strategies that has been used to obtain the market value of all the goods and services produced. The product output method, the expenditure the income method, the product method that look at the economy and the study by industry with the total output of economy is the sum of the output of the every industry. However, since the output of industry may be used to another industry and we of the output of the second industry to avoid counting them twice, we are not value output of each industry what value added. This is the difference between the value of what we put or what it take. The total value produced by economy is the sum of the value added by every industry. The expenditure method is based on the idea that all the product are bought by somebody or some organization, therefore sum of the total amount of the money people or organizations spend on one thing. The amount must be equal to the value of everything product produced. Usually expenditure by private individual, expenditure by business, expenditure by government are calculated separately and then summed together give total expenditure. As a correction term must be introduced to account the import and export outside the boundary. The income method was born by summing the income of all producers within the boundary. Since that period is just market value of the product, their outcome income must be total value of the product, wages, perpetual income, and corporate profit are the subdivision of the economy output. The output approach focuses on finding finding the total output of the nation by directly finding the total value of the world goods and services. Because of the complication, the multiple studies of production of goods and services only a final value of goods and services are included in the total output. This is an issue often called doubling count, wherein the total value of a goods is included several times in national income, but counting it repeatedly in the several stages of production. In example of meat production, the value of good farm may be $10, then $13 from the butchers, then $60 for supermarket. The value that should be included in final national output should be $60, not the sum of all the number. The value added at each stage of production over the previous stage respectively 10, 20, 30. The sum given and relative calculating the final output. GDP at market price, value at output in economy minus intermediate consumption, and P at factor cost. GDP at market price minus net income depreciation, net factor income from a product, and GDP at factor cost. composition of employee net interest, rental, royal income, profit, or incorporated in unincorporated NDP at a factor cost expenditure. The expenditure approach is basically an output method. It focuses on finding a total output of a nation by finding the total amount of money spent. This is anti-typical to economists because, like income, the total value of goods is equal to the total amount of money spent on the good. The basic formula of domestic output take all the different areas is spent within the region, then combine with find the total income. Consumption, investment, government spending, export, import. This way, the measure consists of the one of the gross or net followed by the word national or domestic followed by one of the world's product income expenditure. All the term explained separately. Gross means total product regardless of the use of which subsequently put. Net means gross minus the amount that my used efficient depreciation or year to year obsolescence of the nation fixed capital asset. Net gives an indication how much product is actually available for consumption or new investment. Domestic means new boundaries on geographical. We are counting all goods and services produced in the country boundaries regardless of whom. National means the boundary are defined by citizenship. Nationality, we count all the goods and services produced by the nation of a country which is owned by them regardless where the production physically take place. The output of French count cotton factory in Senegal count as a part of domestic single, but the national figure France produce product as refer to the three counting methodologies explained earlier. The product income expenditure approaches, however, the term used usually product is generally term of often used when any time three approaches were actually used. Sometimes the word product is used, then some additional symbol or phrase. For instance, we got gross domestic product by income, GDP income, GDPI, and similar. Construction income specifically means that the income approach was used. Expenditure especially means the expenditure approach was used. All three counting methods should be theory give the final figure. However, in practice, minor differences are often by three methods, including change in inventory level or statistic. One problem of instance is that inventory have been produced before they included in product but not yet sold. Similar thing users can be slight discrepancy between the value of good produced and payment of the factor that product, particularly if input are purchased on the credit, then also wages are collected after a large period of production. Gross domestic product and gross national product. Gross domestic product is defined as the value of final goods and services produced in with a country in 1 year. Gross national product is defined as the market value of all goods and services produced in 1 year by labor and property supplied by the differential domain. As an example, the table below shows the GDP and GNP and NNI data of the United States. NDP, national domestic product, is defined by the gross domestic product minus depreciation of capital, similar to an NDP. GDP per capita, domestic per capita, is mean value of output production, which is also mean income. National income and welfare, GDP per capita, is often used to measure the national person welfare. Countries GDP more likely to score high on their measure to welfare, such as life expectancy. However, there are serious limitation of the usefulness of GDP as a measure of welfare. How many minutes has completed? Around 19 minutes already completed. You can already see sweat on my face. Because it can be due to the GDP is not than the factor that the quality of life, such as quality of employment, security from crime, this threat to restoration. For example, spending on cleaning up and oil spill. But negative impact on the soil living. GDP means average rather than median. Middle point fell. Countries with a strict income distribution may have relatively high per capita GDP, but majority of citizens has been due to the concentration of wealth. Let's read out the GDP. Yeah. What does it mean? We have already covered one topic around this. Now, I want to talk about capital formation. How does capital form? Capital formation is a concept from macroeconomics, national account, and financial economics. Occasionally, it is used to corporate account. It can be defined in three ways. It's a specific statistical concept, also known as net investment, used to be national account, statistical economics, macroeconomics. In that sense, it refers to a measure of net addition to physical capital stock of a country or economic sector. In the counting interval, measure of amount of which was the total physical capital stock. To arrive the measure, standard valuation principles are used. It is all used in economic theory as a modern general of term of accumulation, referred to the total stock of capital that has been formed or a growth of the total stock capital stock. It is much broader to the term capital formation has a more recent time has been introduced by financial economic to refer to saving drive setting being a financial institution fiscal measure public growing development of capital market privatization of financial institution development of secondary market. It, in this use it referred to a method of increasing the amount of capital owned or under one control or any other method of utilizing mobilizing capital resource investment purpose. Thus capital could be formed in the sense of being brought together for investment purposes in many terms. The broad end meaning not related to the statistical measurement concept nor the skill classical understanding or concept of the economic theory. Instead, it is originated in credit-based economic theory in 1990s 20,000, which is accompanied by the rapid growth of financial sector and consequently increased use of finance terminology in economics discussions. Using national account statistic in national account United States system of national account and European system of account is the total value of gross fixed capital formation plus net changes investor plus net acquisition less disposable or value. The total capital formation in a national account equals net fixed capital investment plus the increase in value of investor plus net sliding to formation. In the US statistical measure of capital formation which was Simon Kuznets in 1991 standard accounting system devised under the different interpretation. The use of capital formation or investment can sometimes confusing partly because of the concept of capital itself can be understood in different way. First, capital formation is frequently thought of the measure of a total investment in the sense of the sum of capital actually used on investment purpose, not health of saving consumer. But in effect, the national account, the concept of gross capital formation referred only the accounting value of addition in the non-financial produced asset of the capital in stock less than disposable of this asset investment. And the physical property or financial investor mean capital formation does not include financial assets such as stock or security. Secondly, capital formation may be used synonymously with the notion of the capital accumulation in the sense of the reinvestment of the profit net. But capital accumulation is not normally an accounting concept of modern account, although it's one of the IMF and United National Conference on Trade and Community Development. It contains ambiguity and the investment of the wealth could occur either the reimbursement of capital asset for one person from either or through a net addition to total stock of capital. As a regard capital accumulation, it is flourish so that some people become wealthier, all the society as a whole become poor. Net capital formation decreases. In other words, the gain could be not total gain, a gain at the expenses of a loss or the cancel. But around 13 minutes already completed in this video, only 2 minutes left. That's the task. Thirdly, gross capital formation is often used synonymously gross to fixed capital formation, but strictly speaking this is an error because gross capital formation refer to the more net asset gain than just fixed capital. A net gain investor stock leaves balance of the fund. Capital formation measures were originally designed to provide a picture of investment growth on real economy in which goods and services are produced using a tangible capital asset. The measure was intended to identify changes in the growth of physical wealth across time. However, the international growth of financial sector has created many structural changes in the way business investment occur, in the way capital finances is really organized. This not only affects the definition of measure but also economists interpret capital formation. Most recent alteration in the national account standard means that the capital measure many other measures no longer fully comparable with idea that of the past except series has been revised to align them with the new concept of definition. US government statistics have admitted frankly that unfortunately the finance sector is one of the more poorly measured sector in national account. The main reason is that national account were primarily designed to capture change in tangible physical wealth, not financial wealth. Gross and net capital formation in economics statistic account and capital formation can be bold across before deduction in consumption fixed capital, net after deduction of depreciation write-off. The cross valuation method for use depreciation for some new income or wealth and are created by enterprise and hence part of the formation of new capital. the enterprise. The new value method of depreciation as comparison of the cost of their application fixed equipment used by whom, which must be deducted from the total investment value to obtain measure real value of investment. Depreciation right of the compensate the cancel out a low capital value asset used to due to wear of tier of loss science etc. This already complete 15 minutes in this video. That's it for the video. We'll see you in that one.